You ever wonder just how fragile a multi-trillion-dollar market can be? Well, it turns out it can be shaken to its absolute core in just a matter of hours. And that's exactly what just happened in the world of crypto. Let's break down how it all went down.
$20 billion. Just let that sink in. That is the insane amount of money that was basically vaporized in one of the biggest single-day liquidation events in crypto history. A number so huge it absolutely rocked the market. But the real question is, what on earth caused it?
I mean, could it really be that simple? Could just one message, one post on social media actually trigger a $20 billion panic sell-off? Well, in this explainer, we're going to unpack the entire story minute by minute. We'll look at the crash, the crazy rebound, and some hidden data that honestly tells a completely different story than what you saw in the headlines.
So first, let's just get a handle on the immediate aftermath. Because this wasn't just a little dip in the market. No, this was a full-on shockwave that rippled across the entire crypto universe. And it was all driven by one really powerful and, frankly, dangerous market mechanism.
Okay, so the key to understanding all of this is something called leveraged liquidations. The simplest way to think about it is trading with borrowed money, right? If the price goes up, your profits get supercharged. But if it drops suddenly, the exchange automatically sells your stuff to cover their loan. And that creates a massive snowball effect of more and more selling.
And that is exactly what went down. On October 10th alone, more than 1.6 million of these leveraged trades were just, poof, forcibly closed. We're not talking about a few big players getting wiped out here. This was a massive market-wide cascade that hit millions of individual accounts.
And man, the damage was just everywhere. This wasn't just about Bitcoin. All the major altcoins, we're talking Ether, XRP, even Dogecoin, they all slumped by as much as 30%. People who were in the thick of it described it as a cascade of selling that just pummeled every single corner of the market.
So, what was the match that lit this $20 billion powder keg? Well, the answer is right there at that crazy intersection of politics, social media, and good old-fashioned market panic. Let's trace the exact sequence of events.
This timeline really lays it all out, doesn't it? Just last week, the market was absolutely flying high, with Bitcoin hitting a brand new record. Then, bam, October 10th, a post from Donald Trump about new tariff threats against China hits the internet, and almost instantly, the market tanks. Bitcoin just falls off a cliff. But then, just 2 days later, a second post appears, a much different one.
And there it is. That was the message. The change in tone is just wild. It's a message of reassurance that completely flipped the market's direction. The same panic that was triggered by one post was basically calmed by another. It's a really stark reminder of just how sensitive this market has become.
So after that second post, the market didn't just stop falling. Oh no, it started a surprisingly strong rebound over the weekend. Let's take a look at just how quickly some of that lost ground was actually recovered.
And the bounce back was fast. I mean, look at this. Bitcoin climbed from way down below $109,000 to back over $114,000. Ether clawed its way back past that crucial $4,000 level, and other big players like Solana and XRP also posted some serious gains, erasing a huge chunk of their losses.
You could literally feel the mood of the market shift too. There's this thing called the Crypto Fear and Greed Index, which kind of measures the market's emotions. It had plunged deep into fear during the crash. But by the weekend, it had already climbed all the way back to neutral. It seems like the emotional panic, at least, didn't last very long.
All right, now this is where the story gets really, really fascinating. Because while all the headlines were screaming about panic selling and liquidations, if you look just beneath the surface, you find a very different and actually much more bullish reality.
So yeah, we saw the headlines, we saw the fear, a $20 billion cascade of forced selling. The natural assumption, right, is that everybody was just desperately trying to pull their money out of the market.
But was that really what was happening? Was this a total universal panic, or was something else going on with the big institutional money?
Turns out, the data tells a completely different story. It's not even close. On October 10th, the actual day of the crash, the amount of money that big institutions pulled out was tiny. For the rest of the week, big money just kept pouring in. They saw the dip not as a crisis, but as a massive buying opportunity.
And this wasn't just a one-off thing. So far this year, the total amount of money flowing into digital asset products has hit a record $48.7 billion. That's more than the entire previous year combined. The big takeaway here is that long-term institutional interest is still incredibly strong, no matter how wild the short-term gets.
So you've really got a tale of two markets right now. On one hand, the bull case is clear.
Records amounts of money are flowing in, showing huge long-term confidence. But on the other hand, the bear case is still valid. Technical analysts are pointing to indicators like the bull-bear index, which dropped 8%, and that could mean there's more short-term pain on the way.
Now, amidst all this volatility and chaos, the industry just keeps pushing forward, making these really strategic moves right into the heart of traditional finance. And a perfect example of this comes from, well, a very famous meme coin.
You heard that right. Dogecoin, of all coins, is actually planning to list on the Nasdaq. They're doing it through a reverse merger, and the goal is to raise money for real-world payment systems and to really weave themselves deeper into retail and culture. I mean, this is a serious move toward mainstream legitimacy.
And just look at the names involved here. We're talking about backers like Elon Musk's personal lawyer and members of the Steinbrenner family. You know, the folks who own the New York Yankees. This is not some small-time project, and the market loved it. Dogecoin jumped over 10% on the news, which shows there's a real appetite for this kind of thing.
So we end here. This whole crazy event shows us a crypto market that's actually incredibly resilient, with a really strong foundation of institutional demand. But it also shows us a profound vulnerability, a weakness to the whims of social media and global politics. The tech is getting better, the big money is flowing in, but the question remains, is the market truly ready for the age of influence?